Wall Street has already made all the money it is going to make on the AI boom, and it has quietly arranged things so that if the whole thing collapses, the bill does not land on Wall Street. It lands on your retirement account. Let me show you exactly how they set that up. In September 2025, Oracle sold $18 billion in bonds in a single day. The money was earmarked for one thing: building data centers for OpenAI. Here's the part that should stop you. OpenAI is on pace to lose about $14 billion this year, nearly triple what it lost the year before. So bond investors were being asked to lend money, secured by a company that loses money, to build computers for a company that also loses money. Demand for that bond came in at $88 billion. Investors offered almost 5 times what Oracle asked for. That $18 billion is one bond sale, one company. The total pipeline of private debt now funding America's AI data centers is projected to add another $800 billion over the next 2 years, according to Morgan Stanley, the bank helping arrange it. And here's the sentence that explains everything else in this video. The banks writing that debt have a specific term for what they do with the risk once the ink is dry. They call it a significant risk transfer. They sell it, usually to a pension fund. Wall Street doesn't need the AI bubble to be real. It needs the debt to keep moving. And it has already arranged things so that if the bubble pops, the bill doesn't land on Wall Street. Here's how that machine actually works. The story you've heard goes like this. Big tech is the most profitable industry on Earth, and it's simply reinvesting its own cash into AI. Microsoft, Meta, Google, these companies throw off tens of billions in free cash flow a year. Of course they can afford data centers. That explanation is not wrong, exactly. It's just the same trick as explaining a casino by saying people come in and play games. Because if these companies were purely self-funding this build-out, none of them would need Wall Street at all. They'd write a check. Instead, in the last 12 months, the biggest AI spenders have gone on the largest debt-raising spree the corporate bond market has ever hosted for non-financial companies. Oracle, a 50-year-old database company, is now, by that measure, the single largest issuer of investment-grade corporate debt in the country. Not a bank, a database company. So the question isn't, can they afford it? It's, why borrow at all if the cash is sitting right there? Here's where it gets strange. Start with Meta. In October 2025, Meta needed a new flagship data center in Louisiana. 5 gigawatts of power, 4 million square feet, its largest project ever. Meta didn't put it on its own balance sheet. It formed a joint venture with a private credit firm called Blue Owl Capital. Blue Owl owns 80% of the venture and paid Meta about $7 billion in cash for that stake. Meta keeps the remaining 20%, hands over the land and the construction in progress, and pockets a one-time $3 billion distribution on top. The venture then borrowed $27 billion, arranged by Morgan Stanley, anchored by the bond giant PIMCO, to actually build the thing. It is, by deal size, the largest private credit transaction ever completed. Here's the part that should make you pause. Meta doesn't just walk away after selling 80% of the project. It stays on as the construction manager, the property manager, and the sole tenant. Meta sold the building, kept the rent bill, and collected a check for doing it. Its balance sheet barely notices the $27 billion in debt because technically it isn't Meta's debt. That's one project. Now widen the lens. Nvidia is putting up to $100 billion into OpenAI. OpenAI is committing $300 billion to buy cloud computing from Oracle. Oracle is spending that money buying chips from Nvidia. Read that circuit again. Nvidia invests in OpenAI. OpenAI pays Oracle. Oracle buys Nvidia's chips. The same dollar clocks in as an investment on Nvidia's books, then walks across the street and clocks back in as revenue for Nvidia. By one count from CNBC and the Financial Times, OpenAI alone has signed close to $1 trillion in AI infrastructure deals this year, a lot of it running in circles just like this one. Here's the number that should worry you more than the circle itself. Bain & Company ran the math on what all this spending needs to produce. To justify the AI infrastructure build-out by 2030, the industry needs to generate $2 trillion a year in revenue. Bain's own projection has it falling about $800 billion short. None of this is illegal. Vendor financing is normal in capital-heavy industries. Telecom did the exact same thing in the 1990s, right up until demand didn't show up on schedule, and the carriers that had borrowed against it collapsed. The entire structure, Meta's joint venture, Oracle's bond, the Nvidia OpenAI loop, assumes the AI revenue arrives on the timetable the debt was priced on. Even JP Morgan's own CEO, Jamie Dimon, put it carefully at a Fortune Summit in October 2025. You can't look at AI as a bubble. Though some of these things may be in a bubble, in total, it'll probably pay off. Translation, from the head of the bank writing some of these checks. Parts of this are fine. Nobody's sure which parts. That's the bomb. Here's the fuse. If a chunk of this $800 billion build-out is resting on revenue that might not show up, the obvious next question is, who's on the hook when it doesn't? Not the banks that arranged it. Not for long. In December 2025, Morgan Stanley began shopping a significant risk transfer on its own AI infrastructure loan book. In June 2026, RBC followed with one tied to roughly $2 billion of data center debt. Here's what that actually means, in plain terms. A bank makes the loan, keeps it on its books, but pays an outside investor an annual fee to absorb the first losses if the loan goes bad. The loan never technically leaves the bank's balance sheet, but for regulatory purposes, the risk is gone. The bank frees up capital. It can go originate the next loan and write the next fee. Who's on the other side, buying that risk for a fat yield? Private credit funds, insurers, and, this is the part that should actually bother you, pension funds. The Federal Reserve Bank of Chicago studied this in February 2026 and found that banks' own direct exposure to AI-adjacent lending looks small, under 1% of assets. Which sounds reassuring until you read the Fed's own footnote. Banks likely have far more exposure indirectly through the private credit funds they lend to, the same funds now holding the risk the banks just sold. This is not one villain, it's a relay. The bank writes the loan and collects the origination fee. The private credit fund buys the risk and collects a double-digit yield. The pension fund funds the private credit fund, chasing that yield to cover retirees who were promised a return. Every link in that chain gets paid before anyone finds out whether the AI revenue actually materializes. Here's the sentence again, with the missing piece filled in. Wall Street doesn't need the bubble to be real. It's already been paid for originating it, and it has spent the last year making sure that if it pops, the loss lands 3 steps away, on money that isn't labeled Wall Street anymore. So, is this your problem? Yes, on 2 separate fronts, not one. Front 1, your retirement account is already betting on this working. If your 401k holds an S&P 500 index fund, the single most common holding in American retirement accounts, you own the Magnificent 7. As of mid-2026, those 7 companies are worth a combined $22 trillion and make up roughly 34% of the entire index. 8 years ago, they were 12%. You were sold 500 diversified companies. You are holding a leveraged bet on 7 AI spenders wearing a diversification costume. Front 2 is newer, and it's the one nobody explains to you. Pension funds, the ones covering teachers, firefighters, state employees, are increasingly the buyers on the other side of these risk transfer deals. They're reaching for the 9 to 14% yields that AI debt risk pays because their own return targets are hard to hit any other way. So the same AI build-out shows up twice in the average American's retirement math. Once as the stock that might be overvalued, once, quietly, several contracts removed, as the debt risk their pension fund bought to chase yield. You are exposed on both sides of a bet you never placed. So, does the AI bubble pop or not? Wrong question. That's the question the industry wants you asking, because it's the one nobody can answer yet, and arguing about it is free entertainment. The right question is the one this video actually answered. Who gets paid regardless of the answer? The bank that wrote the loan and collected the fee. The private credit fund that bought the risk at a fat yield and collected a fee for holding it. Every one of them got paid on origination, not on outcome. The only participant in this entire chain whose money is riding on the actual outcome, whether the AI revenue shows up on schedule, is the pension fund 3 steps removed, and the index fund investor who thought diversified meant something. That's probably you. Wall Street isn't betting the AI boom is real. It stopped needing to. It got paid to build the machine, and it sold the crash insurance before the first payment came due. That's not a bubble. A bubble eventually pops and someone learns something. This is a toll road, and you just found out which side of it you're standing on. So if this was worth your time, take 2 seconds and subscribe. I break down a new one twice a week. Hit the like button while you're at it, and tell me in the comments, so does the AI bubble actually pop, or is it a toll road you're already standing on? I read every single one.